Many early-stage founders and sole proprietors start out running all their business and personal transactions through one single account. It feels much simpler at first to manage everything in one place, but problems might show up later when it can be harder to fix. First, commingling finances, mixing business and personal in the same account, makes visibility much harder. Cash flow, profit, and other metrics are blurred by personal transactions, and the only way to get clarity is to identify all the personal items, which can be a lot more work than looking into accounts. Without a clear view of business-only cash flow, your forecasting could be unreliable or hard to parse. You may end up making decisions without an accurate picture of where your company actually stands. Then we have the tax implications. Mixed accounts can make it difficult to keep clean records. This increases your audit risk and makes it incredibly hard to substantiate valid business deductions. You might end up missing write-offs entirely or filing incorrectly. Mixing personal and business finances can also create serious legal exposure. If you formed an LLC or a corporation to limit your personal liability, keeping everything in one account can easily undo that protection. Courts can argue there's no meaningful separation between you and the business, called piercing the corporate veil. And that means creditors might be able to go directly after your personal assets. Opening a separate business account as soon as you start your business can address all of that. The best time to open this account is the moment you register your company or start receiving revenue. That way, even early on, you never have to clean up messy mixed finances. You get a completely clean view of what the business earns versus what it spends. And it also opens the door to business credit cards and future loans that strictly require a business account to access. The ideal banking setup should offer low fees and seamlessly connect with your existing accounting tools. That all sounds great, but what if your accounts are already commingled? Here's how to separate them. First, get an EIN and then open a business bank account for a fresh start. Every business transaction from here on out goes on that account. Next, go through your past transactions, categorizing everything as either business or personal. This can take time, and it's not always easy, especially if you buy both business and personal items from the same vendors, like groceries and office supplies at Costco, since bank statements and receipts don't always include enough detail. Now, any business expenses paid with personal funds should get recorded as an owner contribution. Personal expenses paid with business funds should be marked as owner draws and reimbursed where necessary. At this stage, working with an accountant can help ensure your tax categories are correct and your owner distributions are validated. Finally, establish strict internal rules to keep things clean going forward so you avoid further confusion. Separation is ultimately about visibility. When you can see exactly what the business has in reserve without your personal finances clouding the view, you make vastly better decisions. You can find the full breakdown on the Mercury blog. The link is right in the description.